Okay, so they've issued some stock, they've issued some debt to pay for this $3.17 billion acquisition. I'm guessing the rest of it came from cash for the most part. Okay, sounds reasonable, perfectly reasonable. Good time to buy too. Stocks were not exactly expensive back in 2010, so they bought at the right time, and interest rates were relatively low. So they they went out and acquired at the right time, and it seems like they waited in the weeds to make their move, and it certainly has paid off so far over the last couple of years. Okay, so moving on here, we can look at our free cash flow and our owner's earnings numbers and how they're playing out. Free cash flow since 2004, 310 million. Um, we had a nice drop over the last 2 years, 585, 46. It's pretty volatile, and then all of a sudden, boom! It just moonshots over the last couple years. So the question is going to be: is this growth a short-term or a relatively short-term blip, or is this for real now? Same thing with owner's earnings. Owner's earnings is a little bit more stable. It went from 53, then it doubled, and then it all of a sudden it shot up. But then it really takes a hit in 2009 during that recession. But then it comes right back after the next couple of years and is stabilized somewhat, back to 2008 levels in here. Um, so let's go through the ratios real quick here, and then we'll get to the valuation. I'm not going through this in as much detail as I do the other ones because you guys kind of know what I look for now after doing 6 other companies. You know I look for low debt, stable cash flow, and growth in top line revenue, growth in margins, all the basic stuff that everybody looks at. So you guys know what I'm looking for, so I'm going through this relatively quick here. When I looked at ratios, this was something that was interesting. Back in 2004, 2006, people had a nice little multiple on this, and then it went down to 4. It was a multiple of 4 in 2008. 12, 25. Now look at our multiple. We're at 6 times earnings, 5 times earnings with cash adjusted, 3 times enterprise value to EBITDA, enterprise value to free cash flow 5, price to sales, price to book. That's relatively low. Price to cash flow and price to free cash flow is 6.24 times free cash flow. That's pretty cheap. I see that as being extremely cheap. RO, return on equity, seems to be pretty volatile. It goes from 8, -5 back then, all the way up to the 50s, and it looks like it's a pretty volatile company. Return on cash, these numbers are high, but they're volatilely. What's the right word here? They're high in a volatile way. So I'm good with the company, but I'm getting a little squeamish on my discount rate because of the risk involved. This looks like a very volatile company when you look at returns and you look at earnings and how the market reacts to it. I'm happy with the growth, but I'm a little bit squeamish on the risk right now on the volatility side. When you look at solvency, though, looks like they're pretty good on the solvency side. Quick ratio, it's almost always over 1, except when it was 0.95. That's pretty safe when you have a quick ratio of over 1. And the current ratio has always been well over 1 and into the 2s. So on a short-term basis, it looks like this is a good company to be in for stability because they're keeping their current assets there. They're not a short-term company that's gonna crash. And then you look at debt to equity, that's pretty low. They didn't have any until recently when they did the acquisition. They seem to be managing that pretty well so far. So they're a safe company in that regard, but they're highly volatile up here, which I like, and that's encouraging that management is not levering up in a company that's volatile. As I said when I did the General Mills video, having a lot of debt's okay if you're stable. This company is not as stable, I guess, predictable in their earnings as a General Mills is. So keeping their debt load down to a reasonable level is prudent and wise, and I like that, and I'm very happy to see that management's not gone crazy, even with all this growth, and levered up too much. They took out some debt, which is okay, but they haven't gone too crazy on it. So I'm good with that. I'm happy with these ratios here, and that makes me a little more comfortable, even though there is this volatility up here. Um, Go through these. SG&A as percent of revenues has stayed really low, so there's not a lot of overhead, back office overhead on this. That's good. Um, Cash conversion cycle's gone down to 6.9 days recently. It was negative 41 for a while, which is interesting that they're converting cash pretty well. So over the last 4 years or so, their cash conversion cycle's been pretty good. So that's good. I'm happy with that. Inventory turnover looks like it's slowed up a little bit. Receivables of turnover, that's a pretty good number. They're getting paid in about 2 weeks from their vendors. Always a good thing. We already talked about their debt structure. Okay, so we've gone through all these ratios. We've gone through the statements. Let's go through the charts here, right here, and just see if anything weird happens. Magic formula. Let's go up to the top here. Free cash flow. Look at this. This is always a good sign. Free cash flow is going up and up and up. Owner's earnings is a little volatile here, but it's up. It's gone up significantly. Earnings per share going up. Good. Like that. Stock price. Okay, that's a good thing. Wish it was down here today, but hey, what are we gonna do? Free cash flow to sales, growing. So they're retaining more. They have more free cash flow from the sales. So that's good revenue out there. Price to free cash flow. You like to see this going down. So market's putting a little premium on this, and this is going down. This is staying pretty steady low. 12.5 was a high. 10.4, 10.6. It stayed low, and now it's at 6.2. That's a low number for a company like this, where free cash flow is coming in. 6.2 times free cash flow. That's cheap. Yield, free cash flow yield, 16%. Nice. I'd like to see them start buying back shares some more, which I believe they were doing when I looked here. I didn't mention that. I apologize. Looks like repurchase of capital stock, net issuance of capital stock. So they spent 1.4 billion, a little bit more than that, on stock repurchases. So they basically bought back their acquisition issuance already and then some. So they got all this revenue out there. They got the money for it, and then they used that free cash flow and bought it back. So they almost got like a freebie out of it. Pretty nice. They used that free cash flow to pay back the shareholders. I like to see that. They are not paying back their debt. They are not repaying their debt back, which is okay when the interest rates are low. Why would you want to pay back debt that's dirt cheap now? They are also paying a dividend. So if you want to do the dividend growth model, 26, and then they stopped paying a dividend for a while almost, and then they've picked it up again recently. So over the last couple years, since 2007, so from 4.5, 22, they get back to their 2004 level. And then it's grown over tenfold in the last couple of years. So the dividend yield is growing here. So I'm finding that this is a nice shareholder-friendly company so far. They're buying back shares. They use share issuance wisely and prudently. You can see why they issued shares, not just maintaining the company and financing the company through stock issuance. They're not paying back debt in a low interest rate environment. I'm okay with that. And they're paying a dividend. They're growing the dividend. So I'm good with that. I'm happy with the way that's gone out so far. I'm a little concerned that this has stopped here, and this dividend has slowed up a little bit. Trailing 12 months, that may be an error in the spreadsheet because I'm getting significantly higher in the trailing 12 months. It's 663.7, not 80.8. on here. So that's Jay, if you're watching this, you may want to take a look at why is that like that. So I'm seeing a lot of dividend out there, another double in dividend growth. Interesting. That's why we always check our numbers and we do our due diligence, not just take things on face value. So anyway, so dividends growing again. Good sign. I like it. Okay, so let's do our discounted cash flow valuation here. So this is what the spreadsheet puts in there. It's telling me that we have an annual free cash flow growth of 22.8% at a 12% discount rate, terminal value 3%. It's telling me that this is worth $900. Stock is currently trading at 182.67, which that's almost down there with ITT Tech range on being dirt cheap. So is 22% growth really feasible? In a small company, I would say yes, that is feasible. However, this is not a small company anymore. The law of big numbers is going to start to take hold here, and growth is not going to be as easy to come by. I like that there is growth. I think there is potential, especially with the Terra Nitrogen acquisition. They are going to grow. I just don't see it being as much. So 22% I think is a little high. I'd cut that down to 12 just to make it more in line with a big company like this, around that size. They're a fertilizer company, so it's not like it's a groundbreaking business that's going to break new ground and change the world. It's something that's been around for a long time. It's it's something people need, so it's stable. So I think we take that into account in the discount rate, but I don't think the growth is going to be there as much going forward. I would say 12% is in line with the market. Maybe a little higher than what the economy is doing, and given they are still a kind of a growth company, but just not as much, I'm willing to give them 12% growth rate on this. Discount rate. So I've got two things that are going back and forth in my mind on this. First thing is it's a pretty stable industry. I mean, it's fertilizer. We're going to need fertilizer for our crops and lawns and all types of other agricultural processes and industries out there. There's going to be a need for this company. There's going to be a need for their service. It's basic chemistry. It's not like something's going to come along and change it that much. Chemistry is chemistry for the most part. And if anything does come along, I think they will be in a position to compete with it rather effectively. So I think that they're stable in that regard, and the industry is stable. And if any time things go wrong, there's always going to be an acquisition target, maybe. Another thing that makes me feel more comfortable with it is how cheap it is right now. At 6 times cash flow, at 6 times earnings, 6 times cash flow. This is cheap. It's already down cheap range. So any bad news is already priced into it. So that makes me feel better about the company, is that it's cheap right now. In addition to that, it is a company that is highly capital intensive. You can't just open up a nitrogen fertilizer plant. This goes along the same lines as food technology service, where the barrier to entry is the risk, and we're seeing that risk right now with their plant having issues. That fertilizer plant having the explosion, the fire. It's high risk, and people are not going to get into a high risk business with just willy-nilly. They're going to have to be a strong case to get into the industry, and that's a nice barrier to entry to have, where it's a highly capital intensive business. You have to build a whole plant, a giant plant, and a whole infrastructure to do it, and there's a lot of risk involved, and it's a highly regulated industry, obviously, because fertilizer may have national security risk, as we saw with Oklahoma City, and you see in a lot of movies. So there is some risk involved also, which creates another barrier to entry, which makes me more comfortable with it. On the flip side, it is a rather volatile company in the financials. It's not the stable companies that we've looked at so far. I mean, it's growing, but when I look at owners' earnings down here, it goes up, it doubles, and then it flatlines, and then it goes up tenfold, and then it's a negative, and then it's down back at 2006, 2007 levels, and then it's up again another ninefold. Very volatile owners' earnings. Free cash flow the same way, 310, then down to 67, and up to 144. Then it triples, almost quadruples. It does quadruple. Then it goes back down, then it's up. It's very volatile. So this is one of those I guess it's a cyclical company is the best way to describe it. But it's a cyclical company growing, and it's growing very nicely. So I've got two conflicting feelings on that. We'll get into part 3 on this and go through that.